Hello students, in the previous lectures, we started with the investment appraisal techniques. This is the chapter 2 of the book, and if you follow my notes, then the numbering will be something different. I told you earlier, so don't be confused on the numbering of the notes number and the chapter number in the book. You can follow either of these two. They are same. Okay, so until now, what we have done, we have prepared the relevant cash flows. And now we are going to apply the investment appraisal techniques. We have applied the one technique, and that is the ARR, or accounting rate of return. Now we have to apply the cash techniques, and here we will apply them. Cash-based techniques are one by one. If I take them, let's start with the IRR. IRR is a technique which gives you the minimum actual rate of return on single project or single investment, not project, investment. Any project which gives us the IRR greater than the cost of capital, it is acceptable for us. You know about it. It is the minimum rate of return. It is not the maximum rate of return. Okay. Maybe possible if IRR is 15%, then maybe possible the project's return rate is more than 15%. For example, let's make an example here. Initial investment is required 1,000. We have a cash flows of 1, 2, 3, 400, 600, 300, and the cost of capital is 10%. So we will going to find out IRR, know about it, that we will be hitting hit and trial, use hit and trial basis. Use the rate, first of all, the discount rate given to you, which is 0.91, 0.826, 0.75. So if I multiply it, 400 into 0.91, 364, 600 into 495, and 225. Okay, and the investment was, this is 1084. Investment was 1,000. So we have a value of 84 positive on 10%. So we have to increase the interest rate, sorry, discount rate. Let's assume it to be whatever the interest rate you pick. Let's say it is 15%. At 15%, first year discountable is given to in the exam, okay? 0.87. It is the basic level. I'm not going to in too much detail over here for this topic. Not 658. Now multiply 400 with 0.87. It is 348. 600 into 0.756, 454, and 300 multiplied by 0.658. This is 197. This is almost give you the NPV of positive -1. Make it almost it is 0. But if you use the formula here for IRR, what is the percentage at which positive net PV was positive? 1. Amount of NPV 84. Add them both and make the difference of the percentages. It is almost 14.95, say 15%. So tell me, is project acceptable for us? Yes, project is acceptable for us because its IRR is greater than cost of capital. So it is acceptable for us. Now we have another technique which is called MIRR. Okay, I'll be making a difference between these two, but let's first of all, calculative differences mirror modified internal rate of return. Its formula is given to you in exam formula sheet will be given to you, rather in the spreadsheet it will be given to you, so don't worry about it. Okay, all the formula sheet will be available to you, and some of the formulas are available in your calculator in spreadsheet. So formula is present value of return phase divided by present value of investment phase into 1 by n into 1 plus RE minus 1. So what is PVR? PVR is the present value of return phase. What is return phase? Return phase means from where you are getting the returns. Let's say you invest in year 1 and you are getting the returns from year 1. Means you invested in year 0 and you are getting the returns from year 1, 2, 3. So 3 years present value is present value of return phase. Present value of investment phase is normally initial investment. N is number of years and RE is the cost of capital. It is cost of capital. So take the same question, same example as above. Present value of return phase. This was the present value of return phase, 1084. This was the present value of investment phase, 1000. So present value of return phase is 1084. Present value of investment phase is 1000. Now use this in the formula here. Mirror formula, 1084 divided by 1000 into 1 by n here, 1 by 3 into discount rate here is 10%, 1 plus RE minus 1. If you solve it, I think there is some net issue. Video is getting stuck. Okay, no problem. So mirror is almost, it is 13%. So still project is acceptable because its mirror is greater than the cost of capital. Another example, if you see, another example, let's say initial investment is 20,000 and we have a return phase from year 1 to 4. In year 1, 2, 3, 4. Year 1 we have a cash flows. Now it is assumed that these cash flows are relevant cash flows which you have studied in the previous lecture. Okay, that should be clear in your mind. 8,000, 12,000, 4,000 and 2,000. Assume the discount rate 8%. So from the table it is given to you 0.926, 857, 794 and 0.735. So the result would be, if you multiply it, 7408, 10284, 3176 and 1470. So present value of return phase is 22338. Now put this in the formula of mirror. 22338 divided by 20,000 into 1 by 4 into discount rate 1.08 minus 1. So here the mirror is 11%. Is this acceptable project? Yes. All those projects which has a mirror of greater than cost of capital, it is acceptable. Now let us see the theoretical detail of the difference between mirror and IRR. First of all, let me check out this web internet connection first. Okay. Now the difference between mirror and IRR. What is the major difference here? If the major difference is of assumptions, okay, the assumptions used. IRR is basically often mistakenly measured as assumed to be the measure of return from the project. It is wrong. It is wrong perception. IRR only represents the return from project. Now this is carefully understanding. Carefully see this one. It only represents the return from project if the funds can be reinvested at IRR for the duration of period. So for example, what is the meaning of this point? For example, in year 1, you have a cash flow of 100. It will be reinvested for the next 3 years at IRR. So this is the assumption of IRR. IRR is using this assumption. Now we have to check out whether this assumption practically holds true. Further problem here is that if a project has, let's say, 2 IRR or more, then again difficulty in finding the IRR of the project. This is the case when you have multiple investments. It is best suitable for single project appraisal. If you have single project, go for IRR. It is not usable if we have mutually exclusive projects. What are mutually exclusive projects? Mutually exclusive projects are the projects that we have two projects, both are favorable, both are profitable, but we have to pick the one. So on what basis we are going to decide the mutually exclusive project? It is not the IRR, it is the NPV on which we will take the decision. Similarly, if I told you earlier that if in case of multiple IRRs, means you have number of investments in the projects, again better technique would be here to use NPV method. This is called conventional cash flows and unconventional cash flows. What are the conventional cash flow projects? Conventional cash flow projects are the projects in which the capital expenditure would be once at the start of the project's life. Then there will be no capital expenditure, and then we will have some operational cash flows. In case of conventional cash flows, you can use NPV or IRR. Both methods can be used. But I said earlier that in case of mutually exclusive project, NPV is better. In case you have multiple investments in a project, here it is not the case of multiple investment. So conventional cash flows projects here, it might be possible that IRR should be a favorable or suitable option here. But unconventional cash flow projects, these are the projects in which we don't have no pattern of capital expenditures. Means year zero capital expenditure, then multiple investment or multiple capital expenditures are there. So in this case also we need NPV method. On the other hand, the mirror, what mirror basically represents? Mirror assumption is that the cash surpluses of any year are reinvested at firm's cost of capital. So this is the major difference between mirror and IRR. IRR has the assumption that all the cash flows will be reinvested at the IRR, which is not possible. It is not possible to reinvest the cash flows at the project's return again. It is possible that you will going to invest the surplus in your business and at least earn the cost of capital. So that is why we can say that mirror is preferable than IRR. It is preferable than IRR. Now let's discuss about payback period, discounted payback, and duration. Now we will discuss these three methods. जी जी, मैं क्लास ले रहा था चाचा जी। आप किसना? 1 मिनट। कौन सा वाला? हाँ हाँ। दूसरी वाले से वो पत्ते पत्ते आ रहे हैं। आराम जाओ जाओगी।